Hey guys, I'm Andre and today I want to share a strategy with you guys that will just bring back 20 to 25% returns on investment every single time you're running it. It's a pretty secure one as well, and obviously every single thing you do in the stock markets comes with a risk attached to it, but this strategy is pretty easy to foresee. You get to choose what you're gonna do, so obviously the better you get at choosing things and at really understanding what might happen, the better your chances to gain success are gonna be. So I do want to mention the caveat here that I only practice this strategy on really good stocks, on fundamentally good stocks. You do not want to try this with shit stocks that just swing higher and lower by 15-20% every single other week. So with that in mind, guys, today we're gonna look at bull put spreads. If you guys want access to my trading portfolio and just to my advice, to all of the community that is constantly exchanging a lot of great ideas, please check out my Patreon down below. And for just $5 a month, you don't only get that, but you also get DCFs and intrinsic value calculations on a lot of really cool stocks. So with that in mind, guys, let's jump into Webull and look at this strategy. Cool. So today we're gonna look at Microsoft here, guys, and the greatest thing is that we can see the fact that this stock is such a bullish stock. Sure, we're not doing great lately with everything that's going on between inflation and obviously what's happening in Ukraine, but guys, just have a look at this. This stock has such a tremendous support at the 300-day moving average on a daily chart, and then if we move over to the weekly chart, we're gonna see that while it seems to be a little bit in the air here, there's still obviously we could potentially find support here at $261. So with knowing this knowledge right now, or having this knowledge right now, guys, and just knowing the way that Microsoft has been trading recently, how do we structure the bull put spread over here? And I will open up the options chart just so we can have a look at what this looks like. And guys, we will want to go out 30 to 45 days. Why this range specifically? Well, it's gonna be because we want to make sure that theta ramps up throughout this whole period. The way we're basically gonna make money here is by selling something, get a premium. Premium basically means that you're getting paid immediately in your pocket, in your portfolio by the broker when you sell this strategy or this contract. And then obviously we want that to expire worthless, or we want to buy it back or at a very cheap price versus the one that we got paid to sell it at. So with that in mind, guys, just know that you don't need to own anything to get started with this. This used to come to really confuse me at the start of my options path of getting knowledgeable. So what we will want to do is, first off, the dollar amounts that you're seeing in the middle column here, for anybody that's really new, these are called strike prices, and they reference the dollar amount at which the security might be trading in the future. So guys, I'm gonna go for the 14th of April, which is gonna be roughly 32 days away from today. You can, if you watch this video in 1 year or 5 years, it's gonna be exactly the same, just follow the same steps. So go out 30 to 45 days into the future and just try to look at delta, guys, and we're gonna want to be at a delta of roughly 0.3 or under. So I'm looking here at 0.25 delta. It's the $260 strike price. And if we go back to the chart, guys, I remember that we said first off that Microsoft has a fantastic support at the 300-day moving average over here, the brown, maroon, whatever color is this moving average. And then if we go over to the weekly, guys, we're gonna see the fact that we drew a line. It's kind of hilarious, but the line here is $261, and obviously nothing is random, so I'm gonna take it. And knowing this, let's move out here and go into the options profit calculator and see how this looks like. What we will want to do is we'll want to sell the option that we just chose. So we're gonna sell the $260 strike price over here. We're gonna sell a put. And obviously, in order to sell a put, or what does this actually mean? It means that you get paid out by the broker and you're gonna get paid out $535. That's a lot of money that you get paid out, but for that you will need to put up an insane amount of collateral, which is gonna be $26,000 $1,000. Not every portfolio has that sort of money. So to sort of cover most of that expense, so to cover that cost, guys, we're also going to buy a put. We're going to buy the put that's $5 less than what we sold. This means a $5 spread or a $500 spread. So guys, we're going to go for this one over here. We're buying it. So let's calculate and see how this looks like. First, we need to understand the fact that we will get paid out the $95 credit that stems from the difference of these two numbers immediately to our pockets in the portfolio. So $95 in the pocket immediately. Now, the max amount of risk that we have here is the rest between $500, the $5 spread, and the $95 that we've already profited. So it's gonna be $405. Now, how does the risk manifest over here? Well, basically, if the stock here by expiration falls flat on its face, goes beyond the $260 mark that we chose for the short call, and ends up below that, we can lose the full $405 collateral that we put up to get the $95. But guys, here's what you need to understand. First off, you should never ever get into the position where you're selling or you're losing all of this collateral. If you guys, so I have a couple of rules usually. If my collateral lost, so if I have a loss here of 1.5x or 1.5 the $95 here, so if I have a loss of $142, I get out of that trade immediately. You know why? I do this because it's always a percentage game. We don't need to be right every single time. We need to be right more often than we're wrong. So for instance, if we do this twice and I have just a 50% accuracy, I don't need more than 50% really. It means that I make $95 twice, so I make $190. But if I only lose $142, it means that I will still have a profit of $48. Now I know this is a bit complicated, and for some of you guys it might seem silly, like why go through the whole problem for just $40. I get what you say and what you mean, but we need to look at things from an investment point of view. And obviously the more you trade this and the better you get at technical analysis, the better you're gonna get at making sure that you're always profitable. If we look at this trade from a chart point of view, what do we need to happen for us to be profitable and get that full $95 into our pockets? Well, the stock can obviously move up, we will make the $95. The stock can move sideways, we're gonna make the $95. The stock can even go down, guys, and it can even go down up to 6%, and we're still gonna make the $95. This is an especially good strategy in times where the stock market is not necessarily bullish, because if the stock market is very bullish, we obviously have better ways to make more alpha on our investment. But with these guys, if you run the numbers, we actually end up making 23% ROI on our investment in just 1 month or in just 30 days. And just imagine if you're gonna be able to make 23% every single other 30 days in your account. It means that you're actually gonna make some insane 270+% ROI on your portfolio. Obviously, if you get anywhere near that, you're gonna end up being extremely rich in an extremely short amount of time. It's harder than it sounds, or it's harder than it looks, obviously, but still, while this strategy has its risks, making sure that you abide by those rules. So always selling at 1.5 loss to what you were making, the premium that you were making, and always make sure that you don't overcommit. Make sure that you always get into a trade when your stock that you want to make this trade with is at the support line, so that you have bigger chances, or at least increase your likelihood. Obviously, if you do this type of strategy when the stock is at an all-time high, your likelihood to succeed is much smaller. That's why we look at stocks that are at support and try to deploy this strategy when those stocks are at support. Actually, when stocks are at all-time highs, we might make a bear call put or a bear call strategy rather than a bull put strategy. So guys, with that in mind, that concludes what I wanted to cover today. This is not financial advice. Please do your own due diligence. It's just an idea on how to make 23% on your portfolio. In case you want to learn more, let me know. We do run a Patreon where we share a lot of really cool trades, a lot of really interesting ideas. It's just $5 a month. If you want to support the channel or just be a member, let me know and I'm more than happy to welcome you guys. That said, I'll catch you next time. Take care.